My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You know why so many bears keep getting this market wrong? It's the Fed. They know nothing. On a day where the Fed presented the results of its monthly meeting, surprise, surprise, they kept rates low. We had to hear endless chatter about how the stock market's in a bubble of the Fed's making. After a good day, Dow gained 160 points, S&P jumped 1.24%, NASDAQ folded 1.35%. You need to know that I think this is totally nuts. Yeah, right. The all-powerful Fed created an environment where equity is the only asset class worth owning and bonds are for suckers. It's all our central bank, possibly with the assistance, let's say, of what? The Bavarian Illuminati? How about the Freemasons? You know what? I am sick and tired of hearing that we're in a bubble, that the Fed's overinflating the price of stocks by printing money to keep the economy moving. Believe it or not, there's more to the economy than just the Federal Reserve, and there's certainly more to the stock market. First, I'm not saying the Fed doesn't matter. Of course it's important. In theory, they could raise short-term rates to 3 or 4, 5. And yeah, that would crush the stock market, among other things. I know that would make the bears very happy. I can practically hear them coming on air and praising the Fed for giving investors a reasonable alternative with higher short-term rates. But do you really think these critics believe a series of rate hikes would actually be good for any asset class? Do you think higher rates would produce more jobs or a better economy? It's kind of important, isn't it? Of course not. See, they would put millions of people out of work and cause a wave of bankruptcies. And for what? A better return from CDs? Well, there's something worth fighting for. Let me be crystal clear. The bearish money managers who want rate hikes don't care about any of this collateral damage. They are talking their book, people. Hey, I was a money manager. Hear them. I know what they're doing. They missed out on the rally, and they need stocks to go down, or else their hedge funds will go out of business. It's about marketing, people. End of story. There's no rational reason to raise interest rates with double-digit unemployment and paltry inflation. Of course, they insist that inflation is about to start raging after that giant $2.2 trillion stimulus package. But we've been hearing the same story since 2009. Oh, yeah, inflation's always just on the horizon. All the smart guys come on and tell us about it, but it never seems to arrive. The bears do have a smattering of history on their side. They argue the Fed needs to take away the punch bowl before people get carried away, and they point out that an inflationary spiral is indeed hard to stop. But they forget that a deflationary spiral is equally hard to stop. Think Weimar, okay? And that's what I'd be worried about in a recession. Deflation makes everything you own worth less. I lived through the 70s. I have no love for inflation, but deflation, it's worse. We've got enough problems right now. We don't need to add a collapsing economy to the mix just because the purists don't think the Fed should keep rates low. Again, there's no serious argument for tightening in the middle of the slowdown. The Fed tried that in 1937, by the way, and it caused a recession within a depression. Why would anyone want to repeat that mistake other than to get things down so they can make a lot of money and market themselves as good money managers? Second point, there's only so much the Fed chief can do to prevent the economy from collapsing. And to quote Scotty, that legendary stock trader from Star Trek, Jay's given her all she's got. His decision to buy some crummy corporate bonds to keep companies afloat, including the cruise lines, was absolutely brilliant. And yes, did he really buy their bonds? No, but get the point. Sure, we've had a number of high-profile bankruptcies since the pandemic got started, but most of these companies were already troubled. JCPenney, Brooks Brothers, Neiman Marcus, J. Crew. They were living on borrowed time even before COVID hit. They'd be doing barely in a decent economy. Powell's simply trying to keep otherwise healthy businesses afloat until Moderna or Pfizer or Johnson & Johnson or AstraZeneca can come up with the long-awaited, much-loved, God-worshipped vaccine. The bears would have loved a more laissez-faire approach that forced Carnival, Royal Caribbean, Norwegian Cruise into Chapter 11. Weren't they candidates for it, right? Wiping out their common stocks so they could profit from the decline. Same with the airlines. Yeah, short American, let it go under. Without the Fed's implicit backstop, plus Secretary Mnuchin's work, no one in their right minds would lend these companies money or buy their stock in a secondary offering. He saved the companies. save the jobs. It should not be controversial other than to the heartless econo-bears. That's my new name for them. I like that. To say that letting these industries go under would be a bad idea. We can't handle that right now. Again, I don't actually think Powell's causing a bubble, which raises all asset prices. I think he's being prudent and recognized that many companies have been turned upside down by the pandemic, and he doesn't want their employees or their shareholders to pay for it. Yeah, he's effectively bailing these companies out, but the alternative is millions more layoffs, people in food lines, people starving. I don't want some money manager making a fortune because, while people starve. It's not right. It's very czarist Russia, by the way. Third, let's take the idea of the bubble head on. Not the bubble head. I'm not talking about this, not this bubble head. I'm talking about taking the bubble head on. If you studied the history of the market, or as you simply as old as I am, as represented by this, you know the Fed has repeatedly been accused of creating asset bubbles. Yet here we are with the market a few percentage points from its highs, watching Zoom video, here wearing masks, and we can't believe, oh, here it is, happening again, money being made. But what exactly is this thing that's happening? Have the markets truly failed us during this period? Sure, individual stock pickers have been able to isolate some big winners. Are they too big? Hey, did the Fed cause the huge gains tonight in PayPal after the close? Did the Fed do Qualcomm? Hey, was the Fed doing Corvo? No, not Jose Corvo. Corvo, the semiconductor company. The Fed doesn't know anything about these companies. I do. They have the right chips at the right time. Good management. Good for them. It's interesting. We got a bunch of trillion-dollar tech companies, and right now the House of Representatives is insisting that they got there via anti-competitive practices. Not an asset bubble. It is the Fed. Is it evil genius? Sister, mother. How about its best of our brainiacs doing what they do best? Attempted domination, which last I looked really is impossible because they shouldn't throw the game, should they? Should they be saying, wow, man, we're really doing well. Let's just throw the fourth quarter. Spike the ball. No! When I look at these winners in this period, I see companies with very smart executives that are simply great at what they do. Many of them have gotten a huge boost from the pandemic. It's not Jay Powell's fault that Amazon's the best way to buy things when you're sheltering in place or afraid to go to the store. Finally, on days like today, when stocks levitate, you can easily say, well, where else is the money supposed to go? The Fed's taking away all the alternatives. Wrong. There are so many high-yielding stocks out there that are actually okay, that you can buy them if you want income. It's just a question you got to do some homework. You don't need to be that creative to find something safe with a 5% yield, but that means you have to actually open a book or whatever, a cyber book. Of course, the dividend stocks aren't the ones that are roaring here. Instead, the winners are stocks of companies that are delivering huge earnings growth and giving us encouraging forecasts. We just heard that from AMD and Starbucks this morning, a pair of great companies that we own for the Charitable Trust, which you can follow by joining the ActionAlertsPlus.com club. And they both did something they wouldn't do before. You see, they gave us guidance, reinstated. And that's what's causing this rally. Reinstated guidance, confidence. Not Jay Powell with low interest rates, but American companies with higher forecasts that we didn't account on, including profits from a weak dollar. The bottom line. Hey, go ahead. You can call it a bubble if you want. You can call it antitrust if you want. I don't care. I call it the Fed choosing not to destroy the entire economy for no good reason. Sure, the Fed could decide to tighten to please the bears and eat it down, make a lot of money, so they get big houses in the Hamptons, including one next, let's say big house in the Hamptons. I could decide to punch myself in the face. I mean, why doesn't Powell tighten? Geez, I don't know. Why don't you put all your money together in a big pile and light it on fire, stuff to the chimney? It kind of seems like a bad idea to me. So the next time some bearish money manager says we need to destroy the economy in order to save it, please remember, most of these people making this argument need stocks to go down to make big money so that they can dominate, so to speak, and get really better houses than you have in the Hamptons. And unlike the four titans who were grilled today, they don't care how it happens or how many people will be hurt by their actions and wishes.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.